What's up, everyone? I want to go over the power of supply and demand, what makes it such a powerful way to trade. I'm also going to go over some key points and briefly go into the mechanics behind price imbalances, how I trade them, and then we're going to get into the charts and I'm going to show you some trades that we took to visually see it a little bit better. But before we do begin, if you could just take 2 seconds, drop a like on this video, subscribe to my channel if you're new, and if you want a very good trading resource, I'm going to link my Instagram in the description below. I post daily trading recaps on here, along with very good trading tips and tricks. The link is in the description below. At InvestorTrade, you're definitely missing out if you aren't following it. Now, let's get right into the video. It doesn't matter what market you look at. The market facilitates trade because of supply and demand, whether you're talking about the stock market, a housing market, a car market. Price will move up because demand exceeds supply, and price moves down because supply exceeds demand. There's no indicators that will physically move price itself other than actual orders coming through the market, with represented by volume, represented by price. So price strictly moves because of supply and demand. When the equation is out of balance or not in equilibrium, this is when we get price imbalances, which is how I trade off of. The large orders, big money will create those imbalances, and our objective and our goal is to trade with them and on the same side as them. Picture you a trader with large size looking to move 5 million, 10 million shares into the market. You're not going to be able to put such large size in the market without one, spoofing it, or without two, getting filled at the price you want to fill. So wouldn't it be much easier to, instead of buying 500,000 shares, you go 50,000 shares, 50,000 shares, 50,000 shares, and you add up into a large position? These things essentially create imbalances in the market once we move out of the balance, when the equilibrium or when the equation is in equilibrium. It all boils down to the supply demand equation. Just understand, once it's out of equilibrium and one side is stronger than the other, we are going to have an imbalance. When supply equals demand, that's when we're going to have the balance. And this is where the large orders and the big money trade, because it's not noisy. They could easily get in and out with liquidity, not spoof the market, and they could build up a very large position, what I call leveraging into the position. Now, this helps you properly read the auction. This is very, very key. This kind of supplements the new videos that I added to the course about market context and reading the auction. It all boils down to understanding buyer versus seller interest, understanding who's showing effort and who's getting rewarded. For example, if we're looking to, let's just say, without getting into the charts too much, the idea is to get long at demand. Let's say we're looking to buy calls at demand. We want to see buyer interest at this demand zone. And if buyer interest is there, but they're not showing any effort to bring it up, or they're not getting rewarded to the upside, those buyers most likely are going to be on the water, and it's not going to fuel a move to the upside. Same thing in a supply zone scenario. It's all about gauging the participation, the effort versus the reward for the participation in the market, understanding who's buying, who's selling, where are people trapped, where are people's stop losses, so you can properly read the auction. And visually, by looking at a chart, no matter what chart you look at, you could understand buyers and sellers in the market and get a good sense of the equilibrium just by watching price and volume develop. Now, those imbalances that I just showed you give me my where I want to be active on a chart. They essentially give me the spots. They advertise price to me. They say, hey, there's an imbalance at $100. Let's see how price reacts when we're at $100. So now that I have my where, price and volume give me my when. This is where supply and demand is almost like a tree trunk, and other strategies and other styles are the branches. Supply and demand should be a core, and you could figure out what gives you your when you physically put a trade on. For me, I only look at price and volume. The beauty of supply and demand is it deals with organic price action. I'm not looking at 100 different indicators that confuse me and that cause noise and don't physically move price. I will only look at price and volume because that's the only thing that can physically move the market. So that gives me my when. And my imbalances give me my where. Price and volume are my validation. Supply and demand are my advertisers to price. Now, with supply and demand as well, we have clear risk management. We have defined risk before the trade is entered. So going back to this setup here, we're going to get into it. Let's just say we're buying calls. We get confirmation once we bounce off a demand. My risk pretty much is going to be at the low. You could put it at the bottom of the demand zone. Again, it's how it fits your trading style, how it fits your personality. You have to conform it to fit what works for you and how you prefer to trade. This also gives me my edge. My edge is supply and demand, and my edge is being able to read the market properly, understanding the auction, and being able to grasp the context between price and volume and between the buyers and sellers in the market. It's my edge. It makes me money consistently in the market, and I don't go every day guessing. I don't go without saying, oh, what is the market going to do? Where am I going to trade? How am I going to trade? I know my setups that make me the most amount of money, and I'm patient enough and disciplined enough to sit on my hands, wait for my edge to be present, and then I put a trade on. I see too many people, let me know, comment if you agree on this. They go into the market and they trade without any confidence. They trade without any style or without any edge, and they're going into the market guessing. They're nervous, they're anxious, because they don't know what to do, because they don't have something that works for them consistently, that they know they can rely on and know what makes them money. So supply and demand is my edge. It essentially gives me structure to a point where I don't want to be too structured, but it gives me this sense of structure that I'm reliant on it and I'm confident trading it because I know this is my bread and butter and it makes me money. And because of that, my emotions are out of the picture. A lot of people trade with emotions, fear, greed, hesitation, anxiety, stress, all common everyday life emotions, and it bleeds subconsciously into their trading. So when I go into the market and I have confidence in my system and my edge and my style, I have no emotions because I know I know I'm going to do what has to get done. And if there's nothing to get done, I'm not going to do anything about it. So my emotions are always out of the picture. I'm disciplined enough to trade when my setups are there, and I'm patient enough to wait for them. People trade to make money. I trade to hit my setups because I know my setups will make me money. Can't be the opposite way around. Do not trade to make money. Believe me, it's cost me, many losses when I first started trading. I would buy something because the market's moving up, or I would sell something because the market's moving down. Trade your setups, leave your emotions out of the picture, and supply and demand does this all for me. Let's try to get this video to 777 likes, and I'll break down those points in detail. To get more context, let's go over the pre-market plan. I post these every single day in the Discord. The first one was on the S&P 500. I used the futures chart to trade SPY options off of it. We had demand at 4207 to 4200. Above it, I was a bull. Below it, I was a bear. The scenario that played out was we were selling off from supply overnight. This supply zone right here, we were moving down. We had the demand at 4207 there to support us if buyers showed interest to defend it. So we had to pay careful attention to price. I'm looking to play long SPY calls if we do bounce here. We just need to properly be able to read the market to put a valid trade on. So going into this action, these zones, I do want to say, are drawn before the market opens up. And as we open up, there are new imbalances that do form, and you have to be cautious and understand to draw new ones as they do form. So selling off from it, buyers had to be proven strong at this 4207 demand zone. And this is actually where I played SPY calls, played the 421 calls. Price confirmed it, volume confirmed it, this imbalance confirmed it, and buyers also confirmed it. So at 9:53, right here, I played the SPY 421 calls at $1.08. This also lined up with support from pre-market in this area. So my risk was extremely tight. Wasn't the best confirmation when I did enter. However, I'm okay with taking not the best confirmation if my risk is tight because I know how powerful these imbalances are. So a couple minutes after, this wasn't working out right away. We came to the lows. We held the lows. We held demand. A lot of people were very short bias on this. This kind of goes with not doing what the crowd does. If everybody's bearish on something, you have to be bullish, and vice versa. So eventually this thing did continue to rally. We came into the supply zone. I wasn't too worried because NQ, the NASDAQ, was showing strength as well. We did bounce off of demand. We were uptrending and we were showing some buyer interest. They just really didn't get rewarded right away like I would have seen for a clean move. This was a little lacking momentum and volatility. It did work out. But other equities like Microsoft, Nvidia, Roku were showing signs of strength as well, which kind of poured more fuel into the rocket right here if we were to move up. So we came to the supply zone, and at 10:26, I exited my full position right here. I wasn't interested in holding for any chop because this thing was low volume. It wasn't moving too fast, and it was a good exit. I followed my plan. I entered where I needed to. I took profits where I wanted to. My execution was perfect. 10 out of 10. I know a lot of members did play SPY calls here from the pre-market plan. And this is where emotions come involved. Hindsight, this thing did continue to rally. Buyers were very strong inside of the supply imbalance. So I would say definitely either sellers weren't showing up or buyers were very strong at this point. So obviously this becomes invalid once we are below it. And yes, the contracts did go up about 120 or so percent from where I entered. And I only got 23% out of the trade, which I'm never going to complain about. Profit's profit. However, you can't let your emotions get involved and say, oh, I made 5,000 on this trade. I could have made 20,000 on this. Yes, it went up 100%, but you did what you had to do. You hit your setup, you followed your plan, and you respected your risk, and you made money off it. Brush it off and focus on the next best setup. Now, at this point, this is funny because it goes right with the post I put on my Instagram last night. This is what I call FOMO hour. Volume died out. If you missed the earlier move off of demand from the plan, which worked out perfectly, you're going to be like, oh, I want to make money on this, but these are not the conditions you want to trade. Volume is dead, momentum's dead, and you're going to start forcing setups based off of emotions and not based off of an edge because you want to make money because you missed a good setup earlier. And yesterday from our plan 2, we were watching the 4165 area. The market opened up. This was Monday, bounced perfectly off of demand, and we continued to rally. It's something similar to what we're seeing today on Tuesday. But what's key here is at the same time, the S&P was bouncing off demand and NQ was rallying. Majority of the underlying equities, for example, Tesla, beautiful rally off of demand. Apple, beautiful rally. Nvidia, nice rally. Microsoft, nice rally. So majority of the equities also were bouncing off demand, which helped the market move higher. And then the market also rallied, and these things rallied with it. So kind of confluence with each other. Any stock, any market, any future, it doesn't really matter. Supply is supply and demand is demand. It's how the market facilitates trade. It's a very powerful strategy. It's my edge. It's unique to my style, my strategy, my personality. I think I'm going to end the video here. If you did enjoy, let's get it to 777 likes. Be sure to follow me on Instagram and also check out the links in the description below. I offer a very in-depth and educational course, which also comes with access to the Discord and goes over everything you need to know about supply and demand. I just added videos about 2 weeks ago, and I don't think prices are ever going to go as low as they are currently. But besides that, peace out.